Shall we kick off?
You look very serious.
Okay, first of all, big thank you to the Schack Institute for arranging this, giving us the opportunity to be back together. Thanks a lot for the organization. Special mention to Robert Blumenthal. Yes, it's a friend, it's a colleague, it's a
Blumey!
Woo! My name is DINO PAPARELLI. I run the real estate debt at Deutsche Bank. I have the pleasure to introduce this group of celebrities in our business. We should go through a quick round of introduction. LAINIE, you want to kick off?
So I think I'm the only one on the panel that there's 3 people here that were or are my bosses. I just want to get that out there. I'm LAINIE KAYE. I run the securitization group with DINO at Deutsche Bank, and happy to be here. This was supposed to be Miriam Wheeler, so hopefully she's getting better, and I'm the understudy.
Thanks.
Jonathan Pollack. I run Blackstone Real Estate Debt Strategies, and before that, I worked at Deutsche Bank with a lot of these people for a long time. Yeah.
Richard Mack, hopefully a good customer of Deutsche Bank, I'm the CEO of Mack Real Estate Credit Strategies, and I had the good fortune of going to high school with LAINIE. So.
Boyd Fellows, one of the 4 managing partners that run ACORE Capital, and I worked with Jeff, Jonathan, and LAINIE over the years, so we're all quite a close group up here.
Yeah, I'm Jeff DIMODICA. If I'm fidgety, it's because I'm trying to pull my shirt out from under my golf jacket that I pulled out of my trunk when I left Miami this morning. Didn't realize how cold it was going to be here, so a little bit awkward. But I run Starwood Property Trust on a day-to-day basis for Barry Sternlicht, and I'm president of our 7 or 8 lending units.
Here we go. Let's kick off. Jeff, let's stay broad first. Is COVID still the catalyst of this discussion? If not, what are the main risk factors today, or generally speaking, where are we in commercial real estate?
Yeah, COVID was interesting, putting a whole recession through 9 or 12 months of a cycle, and we all got challenges from that. And we'll talk a lot probably about the sectors that were helped and hurt by that. But as we come out of it, I think it's really a story today of the weight of money in real estate. And I think back to post-GFC when insurance companies and sovereigns and pensions were buying real estate. And when the GFC happened, everybody was pencils down, cap rates went tremendously wider. What happened now is nothing really went wider. The world was waiting for distress. Distress didn't happen much except for retail, which was coming, and hotels, which closed, and we all expect will come back. And the difference is the Blackstones and Starwoods and large private equity companies have now raised so much money that the weight of money is too great to allow cap rates to back up, in my mind. And you look at $350 billion today per Preqin, that's $1.5 trillion of buying power raised by private equity that's paid to put it out when cap rates widen. At the same time, interest rates come down. So you have $500 or $600 billion of transactions a year. You have too much money to be spent, and then you have private vehicles like BREIT and SREIT and others that are raising $30 billion a year. It's another $100 billion of buying power. There's only $500 to $600 billion of transactions in good years. There's just too much money chasing, and there's too much availability of debt. So I think that overwhelmed COVID and caught people flat-footed.
Gotcha. Interesting. And just to stick to risk, we saw last week the most recent print in the CPI, 6.2. Inflation is above expectation. Jonathan, do you see this inflation, pace here to stay? You see this as a temporary thing, or you think it's going to be the market effect on our business?
Yeah, that's where I would have answered the question you asked with that, which is I think number one on everybody's mind is inflation, and where it goes from here. Is it transitory? There's certain things pushing up. Rents, for example, in our world keep pushing higher and higher. At the same time, shipping costs are coming off, so maybe that's a good sign that supply chains are smoothing out a little bit. The nice thing about real estate, Jeff talked about the weight of money chasing real estate. The fundamentals have been great to go along with that. So rents have been growing, and cap rates, I think, are rationally low given rent growth, given persistently low interest rates in spite of all this inflation. So real estate's been a great place to be hiding out from this inflation because you have growth and levered returns that are are far outstripping the risk there, and we still feel very positive about real estate as a place to be, and also higher yielding real estate debt as well, where you can pretty safely construct a 8, 10, 12% return, again, keeping yourself ahead of wherever inflation might take us. So that's how we're thinking about that.
Gotcha, thanks. Closing the loop a little bit on the pandemic and what has been the last 18 months, I guess everyone or most of us last year had to go through a number of modification, restructure, concession with sponsor to manage the book. I mean, Lenny, you've been part of some of those large restructure. What is did this restructure modification play out? Would you do the same? What is the lesson we learned from this season?
Look, I think, we all mobilized quickly. We were meeting, daily on loans that we thought were going to have issues, and we got in front of it. And obviously, statistics show if you get in front of it, the severity of loss is lessened. And I think we tried to work with them as a partner to work through, to give them enough time on loans on balance sheet, as well as loans that were securitized, that we no longer own, that we were on the phone with servicers, special servicers, how they were going to deal with our borrowers, making sure that they weren't putting them into special servicing too early, because that was just going to start to kill the trust. But it was a good balance, and I think it worked for everyone, for the investors and for the borrowers, to give them some time to weather the storm, both as loans that we had in-house and loans that were securitized. But we were on the phone with servicers and specials that this could have gone drastically, wrong or differently, and it didn't. And I think we were at in June, we were at an close to 9% delinquency rate. That came down 16 months, month over month, to it's now like 4%. So I think, everyone worked together, worked through it, and I think the borrowers and the investors, which is the yin and the yang, tried to work together and were patient in coming out of what could have been a real disaster, and it wasn't.
A bit of patience, yeah. So let's move back to, change the topic a little bit.
I want to touch on that for a second. I think the tone was really set on the restructuring by the banks and by the Deutsche Banks of the world and your competitors. And I think
by the regulators.
I think you guys acted like adults and allowed people the time to work through business plans, both non-bank lenders. We have a special servicer. We had over 1,000 loans come into our special servicer in 6 weeks. We were all hit with an onslaught. And if the tone wasn't set from the banks, who were willing to be partners, work through issues, unlike what we felt in the GFC, I think most of us felt like there were more binary decisions and not much of a willingness to work together. I think your industry set the tone and helped the whole real estate industry really come through much better than it would have otherwise. Because if you guys started taking knives out, it would have happened from us to our borrowers, and it would have been a cascading effect. So,
You tried to be creative, right? You were using reserves to pay debt service. You weren't giving blank. You were giving 2-3 months to try and get through, and I think it worked. Everyone worked together.
Well, this is a crisis that was caused without a villain, right? You couldn't point to some type of financial disruption that created these problems, and I think we were all thrown into this together. Government response was great, but I think there was an agreement, maybe a tacit agreement, for everyone to work together and get through it. And I hope that if this happens again, we'll have a similar response. But when there's a villain, there needs to be some accountability, and usually that creates other incentives than we had during this pandemic.
Let's follow up on a point that that Jeff introduced before, the liquidity in the real estate industry. The capital allocation and the capital inflow in real estate has been increasing non-stop over the last 18 months. Do you see this actually pace can continue? Do you see more money coming into debt, more into the equity, or both of them? What's your expectation?
Yeah, look, I think nature abhors a vacuum, capital abhors a vacuum, and so wherever there's excess yield, cash is going to run in. And I think we are seeing it be more difficult to find the returns we were seeing before. And I think what that requires is for you to try to be a little bit more creative and move towards opportunities. So we're looking at more and more non-traditional deals. Life science, studio space are loans that we've closed. From a market perspective, we're going where the growth is, to markets that are secondary, but where we see greater economic growth, greater population growth. And as a transitional lender, we think we're getting paid to do that. But all of that stuff, will probably get squeezed. But right now, it feels like there's a little bit of opportunity to do a little more interesting things and move to more interesting markets. The other thing that I would just say is that we're noticing, given all the activity and people worried about tax rates changing, big year-end closings. And so right now, if you've got capital and you can meet year-end closings, there's a little bit of a window. And it's those windows that you try to exploit when you see them. And it's timing, it's asset class, it's geographies, and you're always trying to move capital to where you can get a little bit of edge without taking really much excess risk, if any.
Yeah.
I mean, you guys must be seeing record volumes in the next 6 weeks for closing.
Yes.
I think our next 6
All
weeks
of
are
us.
2x what we've ever done before, and we're all doing it. And it's a factor of a lot of things, right? Rates have been low and spreads have held in, but people had time to execute their business plans during COVID.
CREFC is going to be Christmas break for most people in our industry.
That's probably right.
I think we all have a big advantage because we're all running relatively large businesses. And like Richard was saying earlier, we're in competition for these loans, but in this window where they need to close, they need absolute certainty. So all of the competitors who are not quite of the scale of everyone up here are losing deals because we can win deals wide pretty easily right now because they know the borrowers, our clients, know for sure we're going to close. And at year end, it's an opportunity for all of the larger players like us who can really.
And we're all balance sheet lenders, right? And so I think spreads are backing up a little bit to our favor because the CLO market blipped a month ago.
Yep,
so the
that's
CLO lenders aren't as aggressive. And then the bank warehouse lines aren't quite as aggressive with them because the CLO lines blipped. And the bank wet funding facilities where we all put these assets for 6 weeks or so before, they're kind of full because the banks have never seen this much either. So we're all getting a bite at a backup. And I don't know about you guys, we are prioritizing the things that have to close for a transaction, but refis, because somebody wants to lower their LIBOR floor, that's getting pushed to January or February because we're all.
I'm going to come back on the CLO. It's definitely something we want to discuss.
I mean, we're going to be like $45 billion this year, right?
Yeah.
CLOs, which is crazy. We had September and October. We had, in my world, we had 32 deals at $30 billion came out, which is, I can't remember the last time. And the system is stressed. So rating agencies, for the first time that I can remember, one agency passed up 25 deals over the last 3 weeks. I've never heard of where agencies, they don't have the manpower. They've lost 20 people on their team. They can't even process it. So it's not just them. It's appraisers. Everything that's taking 2 to 3 weeks is taking 5 weeks. It's more money. BP's buyers on our side are taking double the amount of time to get through deals. They're focused on rent collections, how they behaved during COVID. So some of the stuff that we're trying to get closed is probably not going to get. It's going to get punted to June.
Which circles back to the question Dino asked to start this whole conversation, which is flow of funds into our space. It's actually been a very good time to have private capital as a release valve for that, right? And I think probably will continue to be. The ability of our sector to provide that, whatever that next tier of financing is, and to flex into more securitizable stuff when that market's not working really well is very healthy for the real estate market overall. I think the scale will continue to grow. I think there's continued capital demand. I mean, with valuations higher, with equity valuations higher, there's definitely capacity in our typical LPs to add to their real estate exposure. So I think we'll continue to see the funds flow.
Talk about continuous capital, coming into our space. I mean, Boyd, you were one of the first to tap to insurance money, okay? But then it's becoming a more frequent kind of source of capital. Do you see life co money coming to real estate as a permanent source of capital? What are the pros and the cons of having insurance money in the way you manage your business?
The insurance market, I think that it has roughly $7 trillion worth of capital within that market, and within the space, there's sort of two groups. One group are all the obvious household insurance lenders who are already active in the space, but the number of insurance companies who do not have lending operations, have very little commercial real estate debt on their books it's huge, but they're very fragmented, and just in the last few months, probably suddenly gone from a handful of like those kinds of investors, investing capital with us, to sort of roughly triple that in the last 6 months. So we're seeing it, but the players who are coming in now typically, more often than not, are on the small side, I would say.
Gotcha.
When you add 20 of them together, it's material, but each of them bites. There are a lot of small bites.
And their normal portfolio is sort of 70% corporate bonds and corporate CLOs, and they have a 30% other bucket, which will include high yield, asset backs, residential, and commercial. But most of them will only get up to 10% or so commercial, but they don't really get close to it as a peer group. So there is a lot of opportunity for guys like Jonathan, who just had an article about it, who can create NIM in commercial real estate. The bogey for these guys, they took liabilities back when rates were a lot higher. Now rates are a lot lower. They're worth less than par. So if they can find any asset that gets them 350 to 375 as a yield, God forbid 4% against the 3 to 3.25 they're earning in the other places, that NIM is really valuable to an insurance company. And there aren't that many quality creators of NIM. The three guys here obviously are, but I think that will be a big part of the growth of non-bank lenders as we be putting out insurance money over the next couple of years.
More money to come. Good. Let's actually, I'm going to ask you something, ask a teacher, but anyone can chime in. We're talking about great liquidity coming to the space, some tightening into the business. I mean, is this actually a context where we can see more consolidation into the real estate industry, but into even the asset management to the extent, generally speaking, what can be, what's your view? You can see any consolidation coming in front of us? I mean, the public to private out there, but, generally.
Well, there are certainly two consolidators up here. I'm not sure I'm ready to be consolidated, but...
It's only a matter of time. We're all going to work with Jonathan, Richard. Just admit it.
So, but I think that's what the big institutional investors want. They want to be able to do multiple investment strategies with a specific asset management partner. And certainly, I think that's, if you want to be in this business, that's the model you have to follow. And so we have investors with us on the debt side that are investors with us on the equity side. And the value of those relationships and the ability to grow those relationships is why I think there's going to be continued consolidation. And then when you look at the value ascribed to managers, that's just another item that really lends itself to more and more consolidation. So I think it continues, and it's hard to start a new business because of that.
I mean, there's value to scale, right? If you're Richard or you're Starwood, you're us, and you own a bunch of real estate, the information you get from that and the way that can inform your decisions as a lender is very valuable to your investors. And the more you see, the more you know, the more you're able to do. But there's also tremendous value in a world where companies like ours are scaling to not being the scale player and being in the channels where we're active and building portfolios. And so that's what makes a market, right? I mean, we can't buy real estate unless other people are selling real estate. We can't finance real estate unless other people are buying real estate. So, the marketplace, I think the marketplace dynamic is very healthy. But I think the more we're able to broaden the product offerings that we have, the better we're able to serve these different kinds of investors that we have.
One thing that's a little interesting about ACORE is, not having an equity shop, being a completely independent, large debt shop has advantages and disadvantages, and the disadvantages are, as you just described, we're not part of an equity shop, we don't have that, but because of the scale of what we're doing and the tenure, we do have the intellectual capital largely that you could ever contend, but it becomes a huge advantage to win deals. So we win deals all the time when we're competing against equity shops because the borrowers, in the end, at the end, will tend to choose us because we're not competing with them otherwise. So it's a mixed bag, but we try to look at it and we think somewhere close to 30% of the deals we win, we outright win win the deal from borrowers simply because we're not part of an equity shop. It goes both ways, but it's an advantage.
To Jonathan's point, we will look at, 150 billion of deals this year to do 10. You'll look at 200 billion or whatever. there's a lot of deals that need to get done by somebody, and everybody has a different flavor. So having smaller people is good, but there is an information advantage being bigger. We borrow better from you and in the public markets, so that's an advantage to create levered yield, which is important. And consolidation is difficult, because to consolidate within the publics, you need to have an above price to book premium buyer with liquidity willing to buy a below price to book who doesn't think he's getting back to book, and they all do. And then they have to have a willing board of directors who wants to lose their job, and it's very difficult to line those two things up. So I don't think you'll see much consolidation in the public space, where you probably would have seen it already.
Okay. Let's go back to capital markets, the public space. Lenny, CMBS, big comeback this year. The numbers are off the chart. What's your experience in terms of how this structure performed during the pandemic? What is the change in the composition of the pool after pandemic? Any change in the in the players? The BB buyers are the same, or different buyers? Take us through these.
I mean, SASB and CLO are obviously on fire. What's remained constant is fixed rate and conduit, and hopefully that's going to start to, more sales going to happen, more need for long-term fixed rate capital. But perversely, our jobs on the securitization side got easier post-pandemic, because before that we were trying to be salesmen of guys that were looking at a balance sheet loan and us, and not want, and the old sort of model of servicers going into a black box and not being able to talk to anybody. Really, I think the pandemic proved out that they were flexible, they worked with them, they modified when they needed to, they didn't put loans into special servicing that they just needed some time to weather the storm. So I think in that respect, it was less, the focus used to be on borrower satisfaction, that they didn't want to go to securitized loans because it was a black box. And some of the shops actually started a concierge service. The concierge service at Deutsche Bank was my cell phone to some borrowers who, said, where am I going to call you when I have a problem and I've got to get money released from a reserve or re-tenant something? And so it was a lot of selling to West Coast clients to say, trust us, try it. And I think the pandemic actually proved to those borrowers and to investors that the structure actually works. In terms of, sort of composition, look, we tried to do a deal right in the wake of the pandemic, and it proved to be tougher. We decided not to go. We waited for some of the stuff to work through. Documents became longer, rent reconciliations became, really long. We were looking at emails from borrowers to brokers to property managers. Were they really asking for a rent forbearance? Were they not? Because remember, I have to disclose everything that's material. So it became really a forensic exercise for us to make sure we were disclosing, which became enormous. But, industrials are still underrepresented in CMBS because it's always been life coast. And we don't have that depth of experience that they do. Neither did the BP buyers who they've been loaning decades from life coast. So industrials got, or like 10, 15%. Multi, obviously we were looking really hard. But the BP's guys right now that we're looking, we're really concerned, obviously, with hotel. That started really low, that's ticking back up. Retail's getting back up. But we started with 40 to 50% office deals in the wake of the pandemic. And that's sort of normalizing now. I could sell 2 or 3 times the amount of deals that we sell to BP's guys. There's always new guys coming in. Just did our first deal with Blackstone that are coming in daily. And the spreads are now mid-14s on a vertical. Mid-13s on a vertical, which, we could just tell someone, I don't even have to market because we know what the market is. We could give negotiated deals 2 or 3 times. So, we're ready to go. It's just obviously the system is stressed.
So conduit's going to grow organically, right? Because this is like, we're kind of at the low point of the 10-year loan cycle here.
And there's $70 billion coming up for refi.
Right, and each of the next few years, that number is going to grow. I guess the question I would have, for you guys is, just given where cap rates have gone, which we were talking about earlier, are you ever going to be able to get industrial financed in these deals, given rating agency constraints around debt service coverage and debt yield? Or has it just become mostly like hotels, retail, and certain office markets? We're trying. The single tenant aspect of it is always harder for the agencies and for BP buyers, and how to re-tenant if that tenant breaks. But we're doing stuff that we hadn't done before in terms of looking at different product types and more hotels, and hopefully, like Jonathan says, from your mouth to God's ears, that we're going to have the conduit's going to start to pick up. Yeah. Has to. Those loans have to get refinanced. Go ahead.
Ultimately, the bond buyers are going to define where things are going to go, right? And there's less fixed rate CMBS than there is floating rate SASB or floating rate CLOs today. And my gut is that we're on a secular trend that continues. And we own a CMBS originator, we own a CMBS servicer. We're very active in the CMBS world. We have a big portfolio of B pieces. My guess is where I started this by saying private equity, $350 billion pent up, the Blackstones and Starwoods, et cetera, of the world have become a bigger footprint. There's just less need for 10-year fixed rate paper because a lot of these funds have shorter fund lives, and they want floating rate paper. And our businesses are booming at the expense of fixed rate. The percentage of floating rate today is much higher than it was going into the GFC and coming out. And I'm a little bit worried. Now you're at a zero LIBOR, and bond buyers are saying we want more floaters, despite LIBOR's at 10 basis points, because they believe inflation's coming. I believe bond buyers will keep voting that way, and fixed rate product will become more scarce, albeit there's a decent amount to refi. But it will be the place, to me, where hotels and retail and other loans that maybe have a harder time in the non-bank or bank market end up. But I'm a little bit concerned where that volume goes.
Well, if you're a borrower and you believe inflation is coming, you want fixed rate paper.
Right.
But our business has become so geared, even on the equity side, to floating rate, to fix and flip, and to being able to have flexibility. I think maybe if people believe inflation is real, we're at an inflection point.
Moving into market opportunities and look also, what is the expectation for next year. I mean, Richard, you were talking about equity, debt. There is any asset class where you can see more capital being allocated going forward, or is a specific geography that you see is not coming back yet, and there could be destination of capital going forward?
Yeah, I don't think I have anything that's really interesting to say, and if I really had it, I probably wouldn't share it. But I think the trends that we've seen around kind of people being able to work in a more distributed way is going to continue to help secondary markets. I think there's a big open question for me as to whether and how strong New York comes back. I think immigration, if there's a change in immigration laws, New York could be really strong. But the conclusion that is pretty clear to me is that bad government and high taxes is a really bad combination. And so it's easier for me to see places that probably people won't want to invest or return to. I think San Francisco is a poster child. I'm a little bit concerned about Chicago as well. But the acceleration of the trends that were existing pre-COVID are going to continue. We need more industrial, we need more housing, and we need it in places that we didn't expect. And so I think that general trend is going to continue, and I don't see it abating for quite a while. I think it's going to be all through 2022 and maybe through to 2023.
Gotcha. Thanks.
And crime. I mean, I remember this panel years ago when Steve Roth was up here, and I think Gary Barnett, and they were all talking about de Blasio was just elected, and they were worried about crime.
Crime's a big part of government.
Crime.
Yeah.
I think COVID made us all suffer from groupthink, and I think we are suffering from a bit of groupthink. We all love multifamily, and a lot of people want to move assets off of bank warehouse lines that have recourse, that have credit marks, and move into something like a CLO where you get out of recourse and credit marks. And so to do that, bond buyers are defining what should go into a CLO. It's always a bad decision when a person sitting in an office in Long Beach, California decides what we should be lending on, and we're doing this all day. And I think that's a little bit difficult, but it's creating a massive bid for multifamily, because everybody wants a CLO with 50% multifamily or whatever it is, and a lot of people who don't have big balance sheets are originating just for that. So I think it's moved the risk reward to sort of higher leverage points and lower pricing than we would like, but we're all chasing that. We're all chasing industrial. We all love A quality office without lease up. We all hate lease up office. Yeah. We all hate the same cities. Maybe the only place that we
don't hate any cities. I hate no cities.
Is on like life science and biotech, and there's probably 4 times as much hitting our desk this year as it was 2 years ago. And we're doing a little, and some people are doing a lot. and I just haven't seen 4 times as many scientists graduate this year as there were 4 years ago. So I have a really hard time thinking every suburban office should be life science and get twice the rent. But people are making those loans. So, but I think we're all in the same groupthink on products. Jonathan, you guys looking at anything?
I'd add a couple of points here. I think I'm fairly constructive on New York. I mean, I think you can see it in the housing numbers. You know, apartment sales are at record levels. Try to find a good rental right now in Manhattan and the surrounding boroughs. It's really, really tough. And I think, you know, to some degree it goes to the flexibility around work. Like, work from home in the suburbs when everything was a little bit weird in the cities was a rational thing to do. But, you know, for the last 20, 30 years, these urban core environments have become incredible places to live. And if you have a little more flexibility about when you go to the office, like having an apartment in the West Village and not having to go to the office 5 days a week is pretty sweet. So I think you're seeing it there. I think the other place you're seeing that work from home, you know, work from anywhere flexibility show up is another obvious one, no secrets here, but leisure travel is, you know, the numbers are through the roof, and we haven't even seen international tourism flow through yet. So we're very constructive on, you know, leisure-oriented hospitality stuff. So I think, you know, there's a lot to feel constructive about. You just have to look around for it.
And hospitality is 5 different markets, right? Yeah. It's destination that I think we all like. It's limited service and extended stay. But everybody talks about hospitality as if every box is a downtown urban box or a convention center box that relies on us traveling. And that's not what most of our loans are or yours. So there are great spots within the hotel market to be aggressive.
And same goes for office, like you said, new, great locations. Even with a little lease-up risk, it's not that risky. That's where every tenant wants to go. And by the way, tenants still need to manage their office space. If your lease is coming up in 3 years, you're finding a new spot and you're going into new buildings. I mean, look at the success One Vanderbilt's been, for instance.
Yeah.
So go ahead.
No, go ahead.
Does it?
I want to actually follow up on this hospitality concept. And at the end of the day, you know, travel restrictions have been lifted. I can tell you that I was supposed to fly from Europe to New York over the weekend. I couldn't find a seat on a plane. So definitely travel is picking up. Are we to a point where the hospitality drama may be basically behind us? Or?
Yeah, again, I think it's just a tremendously different discussion when you talk about corporate travel boxes, your ubiquitous Ritz-Carlton, Chicago, Atlanta, Boston, San Francisco, or convention center box. I'm not traveling. I flew in this morning from Miami. I'm going back. I don't travel as much for business. Our guys who are looking at deals do, but my guess is corporate travel from this room is sub 50% in 23, what it was in 2019 for corporate travel. And it's going to be really hard for those boxes. Everything else is a totally different product. When you're talking about extended stay or limited service or destination, it's not, they all get grouped into one category, but there's one part of the category that's going to be tough. And you know, we're certainly not leaning in on that part, and we're really fortunate that we don't own anything in that part or much in that part today. But
it's also challenging on the cost side in an inflationary environment. And when you look at the jobs data, one of the sectors losing jobs more than others is leisure and hospitality. Right. So if you have an urban full-service hotel, it's very hard to keep it staffed in a cost-effective way.
Getting food.
Yeah.
Well, the hotel union issue in New York is a real one and is making certain hotels very difficult to squeeze any profit out of. And that's not going away. Another kind of issue for the government, because we have to find a way to have people working in a way that's economic. But I'm just going to talk about some of this large group travel. It's not clear to me that it's going away. And if you look at what's happened, and we'll see, a lot of group travel that got canceled during the pandemic has been rebooked. And so the further you look out, the fuller the calendar is for group boxes.
Look at this. Look at the room.
Yeah, so...
They all live here.
Right. Yeah.
I'm the only one who flew in for this.
Would you,
raise your hand if you flew in for this?
If you actually spend the time to look at these big boxes like the Gaylords, for example, they were on a track to come back very quickly until the Delta variant, and then now we're re-looking at they didn't cancel, they just postponed. So I think we have to see what happens when those events occur, and if people really like them, then there will be a future for group events. But I'm not saying it's 100% clear. I can only tell
I agree with you, the group comes back.
The bookings are there.
I just don't think I travel individually to go see somebody in San Francisco to raise money or to talk about an asset. I think
you
I'll
would
do
have
that
done
over
them.
Zoom. But I think group does come back. I just think the bulk of the revenue in a lot of these boxes.
Jeff, I'm taking that flight if you're not going to San Francisco to meet that investor.
we think it will come back, but only to like 80 or 90% of what it was. Our view is that a lot of the behavioral changes that you're referencing are permanent. So we're saying it'll come back and won't be till 24, 25 to really get to 80, 90%. And there's almost no hope it's going to happen by 23. And those boxes are going to bleed between now and then. I mean, being long that will be painful until it wouldn't want to be long that.
Those boxes are going to bleed.
I read a quote for the.
That's pretty
Lloyd Fellows, good soundbite.
John, talk about boxes. I mean, we talk about hospitality. They suffer a lot in the pandemic. May still suffer in a certain aspect. Let's move to the COVID-free kind of industry. The big box of industrial and logistic. The prices have been increasing, margin tightening. Do we have a risk of price of bubble in the industrial, or are you see this industry and this asset class performing going forward?
I mean, the fundamentals just keep getting stronger. You just have to follow e-commerce penetration to chart space demand and rent growth, and then this current supply chain disruption has added another leg of demand to the industrial space, because what had been more just-in-time manufacturing, construction, and things like that, people are now focused on actually having their materials stored somewhere, and that's creating a bit of a pinch in industrial. But I think the longer-term trend will continue. It's a theme that we've pursued pretty much in every corner of the world, and you see the same effects everywhere. I think there will be supply where there can be supply. But I think the Amazons of the world are going to continue to push into the urban core everywhere there's population density.
Gotcha. Richard, you mentioned about talk about New York. Let's talk about you saying about offices. What is the your expectation about the performance of offices? Obviously, there's going to be winners and losers. Should we focus 2 seconds on what's the future of Class B offices in city like New York? Is it just a matter of repricing, or some of the space need to be?
Yeah, no, I don't think it's a matter of replacing. I think Class B office and how we define Class B may mean different things to different people. But if you think about garment center offices mid-block, for example, maybe that's Class C, I think stuff needs to be repurposed, right? It's just the marginal tenant has become economically insensitive when they demand office. So they want the best office. And so you think about these technology companies, offices are very low cost for them. And law firms, for example, might be able to work better from home more. So I think it's the better spaces become more valuable. There are better spaces that are old buildings that have high ceilings, a lot of outdoor space, the ability to repurpose systems and make them very green. An existing building is much greener than building a new building. But my view is that B offices, especially in New York, are going to have to be something else, and that may require rezoning, upzoning to create the incentives to bring that tax base up. But I'm very, very negative on B office, especially in New York.
Okay.
So can we quote you, there'll be blood in the water?
I prefer not to be quoted. We should quote you on that one.
Hey, Jeff, I think we have time for probably one last topic to discuss. Green offices, green space. Last week the conference in Glasgow about environment closed. The outcome of the conference was some of the different views. All the same, ESG is a topic that I think is affecting everybody's life, everybody's business. How this influence your day-to-day business decisions. What is your view on this?
Yeah, listen, it's massive. We're public companies. A few of us up here are public companies, and our shareholders care, and the investors care a lot, and so we have to care whether we want to or not, and we do want to care. So the confluence of that, we have 20 pages probably on ESG in our deck. We're all looking at LEED certified office buildings. We're trying to be green wherever we can, whether it's in the energy usage or our energy lending businesses or our residential lending businesses. Almost everything has to have an ESG angle that we can explain to shareholders, because it's the first question we get asked, especially by the large pensions and guys who manage money for others. So it's super important to them, so it has to be for us, and we all have to sort of learn to make sure that we're doing the right thing with our borrowers, and that's sort of hard medicine for borrowers, and borrowers are going to see worse pricing and lower advance rates on product where they can't make a green argument around it.
Yeah. Anyone know? Want to chime in on this, or I think it's...
Yeah, it's a big focus, and on the energy transformation that's happening around us, real estate's going to play a huge role in that. A lot of this is very physical. Our industrial portfolio just announced a big JV for solar power in the Northeast. We're buying a data center business that's getting close to being entirely carbon neutral in its energy consumption. By the way, a lot of that's driven by the tenants in data centers who want to have that for their entire, these giant tech firms want to have that for their entire business. So, I think we're at the beginning of that story, and I think all of us, in the things that we own are going to be very front-footed about that, and obviously always very focused on good governance, always very focused on bringing more diversity into our industry, into our company.
And our kids will be proud of us if we lead this, right? It's not just the economics, it's the right thing to do, and we all feel great about it for the first time, that you can make a non-economic decision because it's the right decision to make, and we're all making those.
As a lender, it's tough to really have much of an influence. I mean, it's really hard to say that you're going to try to tell a borrower what to do, but the one thing that we can do, and this way we think about it within ESG, is focus on diversifying our employee base and put a lot of energy into outreach and really being, setting metrics for ourselves and executing on it and going to, something we can be proud of. We're starting to see a real transition in our employee base and what it looks like, and we think we can make real progress on that. That's something as a lender we can actually change.
Where I do think it's a credit issue, though, is that as more and more buildings incorporate, renewable energy and other forms of energy efficiency into their footprint, buildings that are falling behind, that just becomes deferred maintenance, like meaningful amounts of deferred CapEx. And so, as people making credit decisions as lenders, that's going to really begin to factor in more and more into what we do.
Look, I think this has to be part of everything we all do as an industry, and there may be a role for public-private partnerships around the capital markets. So if a building is green, maybe there should be some subsidy around its cost of financing. Mm-hmm. So I think this is such a big part of our lives, and as capital market participants, being creative about what can stimulate the ability to make our business more diverse, more green, I think is important. And we should be constantly thinking about what those innovations are. And I imagine there are students in this room that will come up with a disruptive innovation around how we can do a better job. And I think there's going to be a lot of demand for that.
Okay, I guess we're good with time. Thanks a lot, guys.
Thanks. Yeah.